AI stocks just went through another wild swing. And if you're not paying attention to what's driving this volatility, you could be missing the biggest signal in the market right now. Welcome back to AI Assets. Today, we're breaking down why AI stocks are on a roller coaster, why the S&P 500 and Nasdaq keep whipsawing between record highs and sudden drops, and what this actually means for how you should be positioning your portfolio. Let's start with what's happening. Over the past few sessions, we've seen AI stocks swing hard in both directions. One day, the Nasdaq rallies and pushes the S&P 500 to the edge of a new record. The next day, those same AI names reverse and drag the whole market lower, even as most individual stocks in the index actually go up. That's a critical detail. When the majority of stocks rise, but the index falls, it tells you the moves are being driven by a small handful of mega-cap AI names, not by the broader economy. In other words, the market's mood right now is almost entirely hostage to sentiment around AI. We're also seeing this volatility spill into Asia. South Korea's Kospi dropped sharply, and Japan's Nikkei fell as well, even after Samsung posted extremely strong earnings. Samsung's profits jumped massively year over year, and yet the stock still fell. That's not a normal reaction to blowout numbers. That tells you expectations were already priced for perfection. At the same time, hedge funds have been quietly reducing their exposure to chip stocks for 4 straight weeks. Semiconductor indexes have pulled back meaningfully, right before several major companies are set to report earnings. So you have retail enthusiasm and record-high index levels on one side, and smart money quietly trimming risk on the other. Now, why does this matter for you as an investor? First, this is a clear sign that we've entered a more mature, more nervous phase of the AI trade. Early in a bull cycle, good news pushes prices up, and bad news gets ignored. Late in a cycle, even good news isn't enough if expectations are too high. And that's exactly what we're seeing with reactions like Samsung's. Second, this affects how concentrated your risk really is. If your portfolio is loaded with the same handful of AI megacaps everyone else owns, you're not just exposed to their business performance. You're exposed to a coordinated wave of sentiment that can swing your entire portfolio on a single earnings call or macro headline. Third, this is a signal about semiconductors specifically. Hedge funds trimming chip exposure for a month straight, right into earnings season, is not a random detail. It suggests professional investors are positioning for disappointment or at least a sell-the-news event, even if the underlying AI demand story stays intact long-term. So what is the market missing right now? Most headlines frame this as a simple binary. Either AI is a bubble about to pop, or AI is unstoppable, and every dip is a buying opportunity. The more useful lens is that we're watching a repricing of expectations, not a referendum on whether AI itself is real. The demand for AI compute, AI infrastructure, and AI-powered products isn't disappearing. What's happening is that markets are recalibrating how much future growth is already baked into today's prices. When expectations get stretched too far, even genuinely strong results like Samsung's can trigger a sell-off, simply because great wasn't great enough relative to what was priced in. There's also a subtler pattern here: correlation risk. When AI stocks move together this violently, it means diversification within tech isn't doing what many investors think it's doing. Owning 10 different AI-adjacent names doesn't protect you if they all react to the same sentiment shifts at the same time. That's a risk factor that rarely gets discussed in mainstream coverage, but it's critical for how you construct a portfolio in this environment. Now let's talk about what happens next and what you should be watching. First, keep a close eye on upcoming earnings from the major chip and AI infrastructure companies over the next few weeks. Watch not just whether they beat expectations, but how the stock reacts afterward. If strong results keep getting sold off, that's your confirmation that we're in a priced for perfection phase. Second, track hedge fund positioning data and options flow around semiconductor stocks. Continued reduction in exposure, even during a rally, suggests professionals expect more turbulence ahead. Third, watch how Asian markets respond to their own AI-linked earnings and IPOs in the coming weeks. Sharp reactions there often serve as an early warning system for what could hit US markets next. From a portfolio perspective, here's how I'd think about this. This is not necessarily a moment to panic and exit AI exposure entirely. It is a moment to stress test how concentrated your risk really is. Ask yourself honestly, if your 3 or 4 largest AI holdings all dropped 10% in the same week, what would that do to your overall portfolio? It's also a good time to separate companies with real monetizing AI demand from those riding pure narrative and multiple expansion. The businesses with strong cash flow, real enterprise adoption, and disciplined capital spending are far better positioned to survive volatility than speculative names. The bottom line is this: AI stocks aren't broken, but the easy phase of this trade, where almost everything goes up together, may be behind us. Going forward, stock picking, position sizing, and understanding correlation will matter more than just being long AI in general. If you found this breakdown helpful, make sure you subscribe to AI Assets for daily no-hype insights on AI investing, from chips and infrastructure to platforms and market psychology. Let me know in the comments. Do you think this volatility is healthy repricing or the first real crack in the AI trade? Thanks for watching. See you tomorrow.